What do all these winning setups have in common? We have a key level, price is coming into that key level, it is creating an opposing level or a CISD. Once it breaks that level, that is our key to enter, and price moves in the opposite direction and takes out our liquidity. You can see price comes down, taps into a key level, sweeps that level, creates a CISD, breaks the CISD, which is our confirmation, and then price moves all the way into our liquidity. Price moves up into our key level, it creates a sweep, then it forms our CISD. Price then breaks the CISD, which confirms the sweep, and that is precisely where we look for an entry, and we can target our lower liquidity levels. For our short example, you can see price is tapping into a swing high or a key level, and then it forms a sweep at that key level. We wait for a break of the CISD to confirm that the sweep is valid, and then we look for an entry, and then we can target our lower liquidity areas. All these examples have the same thing in common. In this 3-step formula, I'm going to break down step by step exactly how it works. This is everything you need to know to start winning in the market. Step number 1, mark out your key levels. The key levels you want to focus on is fair value gaps, daily and weekly highs and lows, and opposing candle levels. With fair value gaps, all you want to see is displacement occur in the candles. It creates a gap or a space between 3 candles. This space is known as an imbalance, and these are very important key levels that price loves to come back to. Fair value gaps is a sign of displacement in the market. It represents a pull and push mechanics. So here's an example. You can see we get a fair value gap created, which forms this displacement to the downside. So this can be a sign to trade away from. And then once again, this can be also our key level, and we can trade towards it again. We know if price moves away from a fair value gap, eventually it will find stability, and then it will come back to that fair value gap. Or we can wait for price to reach the fair value gap, and we can look for a short entry off of that fair value gap. Here's an example. You can see we get this break of structure to the downside. It forms a fair value gap, creating displacement. We mark out that level, and we can trade away from that level number 1, or we can wait for price to come to another key level. We can enter that long, and we can trade back towards the fair value gap key level, or we can wait for price to come to that key level, and we can trade away from it. Here's an example of how fair value gaps and displacement work hand in hand. So you can see over here, we get this massive displacement to the upside, and guess what? It creates a fair value gap. We mark out that fair value gap, and we wait for price to retrace to that fair value gap to look for our continuation entry. Then we get another big displacement to the upside. It forms another fair value gap. We wait for price to come back into that fair value gap, and we can look for another entry. Fair value gaps and displacement come hand in hand, and this is a very key component you can use to your advantage. Another key level is using our daily and weekly highs and lows. These are very important key levels you can use. What you want to do is you want to mark out the daily highs and the daily lows, or the weekly highs and the weekly lows. And what you want to ask yourself is price more likely to reach for a previous high or a previous low, depending on the location? If it's below the equilibrium 50% level, there's a high probability it's going to reach for a low. If it's above a 50% equilibrium level, there's a high probability it's going to take out a high. So we can use this to target these key levels. Reversals can be framed off highs and lows when there is a failure to displace. So what you do is you wait for price to come to a swing high point, and then we want to see a failure to displace pattern or a sweep occurring at that key level. Or you wait for price to come to a daily or weekly low, and we want to see a failure to displace happening. Super simple pattern that gives us a very strong sign that price is going to reverse off of these key levels. And then we go into our opposing levels. These are extremely powerful levels. They help you break down the blueprint or the scaffolding of the market, and they show you very valid points where you can look for entries or exits. If we get a succession of higher highs and price keeps breaking these higher highs, it's showing continuation to the upside. Then comes a point where we get a failure to displace, where price is not able to sustain above the previous high points. This is showing weakness, and this is a key factor in looking for reversals. When we see price come and break the higher low or breaks the CISD that's created, this is a very strong sign now that we're getting this weakness, and this is precisely where we can start looking for an entry into the market. Once price comes down and breaks the CISD, it often breaks with displacement, leaving behind fair value gaps. Then we get retracement back into the fair value gap, and if not into the fair value gap, it forms another lower high. Once price breaks the lower low again, this can become our continuation entry. These opposing levels can be used on higher time frames and lower time frames. So you can see over here, I've marked out all these opposing levels. Opposing levels are really just high and low points that are formed in the market. You can see we've got a swing high and a swing low. If price breaks above these swing high points, this can be a sign of strength and I'm looking to long the market. If price is breaking below these swing low points, this is a sign of weakness and I'm looking to short the market. Here's an example of the same idea. I've just marked it within a line formation, and you can see I've just marked out the swing highs and the swing low points, and these become very valid support and resistance levels. So there's no more wondering when you trade a break or close below for a short or a break or close above for a long. After you understand where all these key levels are located, we move to step number 2, identify the higher time frame sweeps. Higher time frame sweeps, also known as swing points. This is the pattern you want to pay close attention to and be able to identify. The market cannot reverse without creating a swing point. So you always want to be able to identify a swing low or a swing high happening. This is giving you a strong clue that the market is going to reverse. Key component that you really want to keep in mind is that you want to see price come to a key level, and then you want to see it create our swing point at that key level. Price comes into a key level, it forms our sweep. And this sweep, whether it's happening on the daily, the 4-hour, or the 1-hour, is giving us clues that there's a high probability that the market is going to reverse. You can see for our short position, price comes up to our key level, whichever key level we've marked out, and then we want to see our failure to displace pattern happening or our sweep happening. This is where a swing high is developed in the market. Once we get this closure of this candle, this failure to displace happening, this is a strong sign that price is going to reverse off this level. We can use our daily, 4-hour, or 1-hour to identify these. Step number 3, CISD entry. Once price comes to a key level and we can identify a swing point or a sweep occurring, then we want to mark out the CISD. And the CISD is the candle or series of candles that cause the sweep to occur. So a CISD is always going to be followed by a sweep. Remember, the candles or series of candles that causes the sweep to occur become the base of the CISD. Once price breaks and closes that CISD, that is precisely where you want to look for an entry. So on the higher time frame, the daily, 4-hour, or 1-hour, we want to identify a sweep occurring at the key level, and then we can jump onto a lower time frame, either a 1-hour, 15-minute, or 5-minute, to look for our entry when price breaks and closes through the CISD. Now for our short example, you can see prices coming, tapping into our key level, and then we're getting a sweep forming or a swing point developing. This is our failure to displace signature. You can see on the higher time frame, the daily, the 4-hour, or the 1-hour, we get this failure to displace or the swing point developing at a key level. Then we jump onto the lower time frame, the 1-hour, 15, or 5-minute, to look for our entry at the break of the CISD. Remember, it's the candle or series of candles that causes the sweep, that causes the manipulation, where we mark out the base, which is our CISD level. Once price breaks that level, that's a strong confirmation and confirms the manipulation, confirms the validity of the sweep, and that's precisely where we enter on the candle closure. You can also wait for the retracement back to the fair value gap, as majority of the time price creates displacement when it breaks the CISD, leaves behind a fair value gap. So either price can retrace back to the fair value gap, or it will simply break the CISD and just melt. So here's a good example of how it all works. You can see we get price breaking structure to the upside, breaking these opposing levels, showing strength to the upside, and then suddenly we get a failure to displace, where price is not able to hold above the previous high, showing weakness, showing our sweep, showing our swing point developing, and then we get our CISD. Price breaks that CISD, and this is the signature you want to pay attention to when you're looking for a short. For our long signature, you can see prices breaking structures to the downside, breaking these opposing levels to the downside, and then suddenly it breaks this level, but it comes back into the range, forming a failure to displace pattern, and then it comes up, breaks the CISD, which confirms this reversal signature. That is your sign and your trigger to enter a long position. Let us sum up this complete strategy. Number 1, you want to mark out the key levels on your chart. Number 2, you want to identify sweeps or swing points occurring at those key levels. And number 3, we want to identify the CISD, and that is our entry trigger. Let us now tie this all together on the charts, looking at real examples. Here we are on a cryptocurrency chart, but this strategy works no matter what you're trading, whether it's forex, indices, stocks, it works. If there's a chart, it works. So first thing you notice over here is we've got this unmitigated fair value gap, and we mark that out. That becomes our key level. And then you can notice price has come and price has tapped into this key level. This is the first step in the formula. You want to mark out the key level. You want to wait for price to come to that key level and tap into that key level. Once it taps into that key level, we jump onto a lower time frame to have a look, and you can clearly see, if you look over here to the right in these higher time frame candles, you can see the daily candle is showing our failure to displace happening within our fair value gap key level zone. And then it projects this onto the lower time frame chart, which is our 1 hour chart. It shows the sweep occurring, and it shows the CISD levels being created. The key to marking out CISD levels is you want to focus on the candle or series of candles that cause the sweep to occur. And then you can see price comes back into the range. We mark out these CISD levels, and these become our entry levels. So now we want to see price break our CISD, and you can see, look at this. So price breaks the CISD, and what does it leave behind? It leaves behind a fair value gap, which is showing us there's displacement occurring to break the CISD level. Something you also want to pay close attention to is that when price breaks the CISD level, it breaks it with this V formation. Can you see? We get this aggressive move up and this aggressive move down. This is confirming for us that this is our manipulation, and this validates our sweep as being real. Once price breaks the CISD, we can look for an entry. Now, there's a few different ways we can enter. We can enter on the break of the CISD, the break and the close, and stop loss comes above the sweep. Or you can brace the stop loss above the sweep level, depending on your tolerance for risk. And then we target the lows. As you can see over here, we've got these lows, which become excellent places for targets, and this becomes our setup. So you can see price retraces back into the fair value gap. Can you see? Just into the fair value gap level. See, so this would have been our second entry. First entry we could enter at the break. Our second entry we can enter when price comes and taps into the fair value gap. It basically almost tapped and just missed it, and then we had the drop. You can see then price came back up, and then we get the drop. There you go. So you can see price doesn't move in straight lines. We get this drop, slight retracement into this fair value gap region, which would have been a second entry over here. Otherwise, this price drops again, comes back up, taps into our opposing level. So I go through opposing levels in great detail in the course. If you don't know about opposing levels, you definitely want to learn about them. Taps into the opposing level, and then we have this massive drop, and this drop comes and takes out our lower liquidity line. You can see in the algorithm, it's marked out for us these actual key liquidity areas, and price tapped into that area and responded very nicely from that point. In the second example, we're going to use our swing high points, or a weekly high point. You can see this is our highest high on the chart, and this is a weekly high. These are excellent liquidity areas where we can look to take trades from. When you mark out key levels, it's best to use either a daily, a 4-hour, or a 1-hour time frame. So it allows you to have a clear look at the chart to find out exactly where these key levels are located. Now that I've marked out this previous week high or the swing high point, I'm going to jump to a lower time frame and see what it looks like on a 4-hour time frame. Come onto a 4-hour time frame, and you can see over here, if we look at these weekly candles, these are expansion candles. Expansion candles have these very small wicks and these big bodies, and they often make very big movements. And this is why we're waiting for this trade to hit a key level so we can wait for our short position. Remember, when the market goes up aggressively, it's going to be a point that it's going to hit where there's going to be a drop. So now we've come onto a 15-minute chart. You can see prices tapped into our previous week high. It's come into our key level zone. So this is the first step complete. Now we want to observe a failure to displace pattern happening on a higher time frame. On this higher time frame chart over here, we've got the 4-hour time frame. So let's see, we want to see a failure to displace pattern happening. And there you go. You can see we've got our failure to displace pattern happening on the 4-hour chart. And what does it do? It projects for us a CISD on the lower time frame. So how do we work out the CISD? The CISD is going to be the candle or series of candles that caused the sweep to occur. Can you see this was the start of the sweep, and it swept up the high here? So this marks out our first CISD level. and this becomes our key level that we want to see price break before we look for an entry. So let's go to the next frame. So there you go. You see we get a nice break of the CISD. This can become our entry point. We can enter on the break and closure of the candle and set our stop loss above the previous high point. This becomes the safest place to set your stop loss, because if this is in fact a true manipulation at this point, price will not retrace past this level if this is in fact a true manipulation point. So this becomes our entry. Where do we look for targets? So we can target the low liquidity areas over here. It all just depends on your risk appetite. You can see on the higher time frame candle over here, there's a 4-hour candle and this is a 4-hour low. So we can target a 4-hour low or a 1-hour low, and areas that we could set would be these low areas. This could be a potential place to have a target, and this low could be a potential place to have a target as well. Just depends on what kind of risk to reward you're looking to go for, or you could set it all the way down here where the software actually marks out this level for you. So let's see if we stick to this point. Let's see how this plays out. So there you go, taps into our first area. So you could always take partial profits at this area. And then what you want to do is you want to move your stop loss down to entry. So from this point, it becomes a risk-free trade. And then let's see if it'll go to our next liquidity region. And there you go. So look here, then price consolidates slightly. We get consolidation occurring. And then you'll notice we get another sweep occurring. Can you see over here on the higher time, we get a sweep occurring. The sweep occurs and it forms another CISD. Just to highlight, CISD is the candle or series of candles that causes the sweep to occur, and then price fails to displace back into the range. So this could become another entry point. On the candle break, we can set stop loss above this high or above the manipulation if you want to be safe. And then we can target all these different liquidity points. This could be the first, second, third, fourth. So it all depends on your risk appetite. So let's target the first and see if it hits it. And there you go, price hits our low liquidity level and we can take profits on this trade as well. So you can see sometimes we will get our main entry and then we'll get a re-entry. Price will exhibit the same criteria, but the key to notice is that when displacement starts to form like this, then you know the bears are starting to come into the market. And then for our third example here, we're going to use the opposing levels. So whenever I'm marking out my key levels, I can use fair value gaps, I can use swing high or swing lows, or I can use opposing levels. At this point over here, you see we get an opposing level, so I'll mark out that opposing level. And at the same time, we get swing high points over here, and I'll mark that out as well. So whenever price comes to either opposing level or a swing high or a fair value gap, that's where you want to look for a swing to occur. So you can see price taps into this level over here. Then we drop into a lower time frame. So I drop onto a 15-minute chart. It's the 15-minute lower time frame and the 4-hour higher time frame. So you can see price is tapped into the opposing level over here. And now all I want to do is I want to see the rest of the criteria develop. I want to see a swing formation form at this level on the higher time frame. So we wait over here. And there you go. You can see we get a swing forming on the 4-hour time frame. The swing formation is forming at our key level. So now we go to the lower time frame and you can see over here, you can clearly see that we had a CISD that was formed. The CISD, remember, is the candle or series of candles that sweeps the previous high. And then price sweeps the high and comes back into the range, breaking that CISD. This becomes our entry criteria. We can enter on the candle close, stop loss goes above the high, and then we can set our target at a relevant liquidity point. You can see over here in the opposite direction, these are fair value gaps that were created from this expansive move, and fair value gaps can be excellent places to look to take profits. So I can set my profit at this fair value gap right over here. And let's see. Price melts. So it takes a while to get there, but then it actually starts to form another sweep, as you've noticed this happening previously. So this can be a place where you could actually look for another re-entry, or if you haven't entered yet, this can be an entry point. And we can mark this liquidity, or we can mark it on this fair value gap down over here. So let's play it out. There you go, it taps into those key levels. And there you go, it comes all the way down, tapping into this fair value gap. Also notice over here at this sweep that occurred and we got the displacement breaking the CISD, it formed another fair value gap, and then price came, tapped into that fair value gap where it actually reacted off of, and then we got the drop from there. So as I say before, there's multiple different entry points using this strategy. If you're interested to learn more about it or to use the software that I'm using to mark out sweeps and CISD levels, click the link below. We have a free trial. You can test it out for yourself. If you want to continue learning about this strategy, make sure to watch this next video where I go into even more detail so you can master exactly how this works.